Hello, my name is William, and along with my team, Paige, Motoko, and Miriam, we will be presenting a case study on Logitech, focusing on the financial results of the fiscal year end March 31st, 2011. Today, I will offer some insights to the company and what Logitech does and how the company ended up committing fraud in the millions by manipulating operating income by avoiding proper inventory write-down during the fiscal year end March 31st, 2011. Logitech is a company that builds and designs peripherals for computers, products like keyboards, mouses, headsets, and speakers, to name a few. In 2010, Logitech released a new product called the Review that integrated the internet with TV, much like the Roku or Amazon Fire Stick. The product essentially broadcasts the internet to the TV. Logitech had big expectations for the product, and the forecast by management represented their optimism. They expected to sell 350,000 units a Review, but fell short of that heavily by only selling 165,000 units in the fourth quarter of 2010. The quarter Review was released. Prior to the actual numbers, Logitech had informed its manufacturer of Review to go ahead and purchase $11 million worth of parts to build out the Review based on their forecast for the product. The issue is Review sales were 70% below forecast and continue to fall throughout the year. Before fiscal year end 2011, the plans for Review were to discount the finished inventory until units were sold off and to sell the millions worth of inventory purchased by the manufacturer to build Review for whatever they could get. Basically, Logitech was discontinuing the Review and selling off the inventory used in the making of it. VP Global Sourcing, who was responsible for inventory, liability, and risk, had made it clear there were no plans to build more Review units and to sell all finished inventory and inventory related to Review for whatever Logitech could salvage, even if it was zero. Review was a failure and led the company to revise its annual operating income for fiscal year end March 31st, 2011 from 170 to 180 million to 140 to 150 million. This caused the share price to drop 16%. Because the company had millions of inventories that were to be produced to Review and had no plan to use the inventory to build more, they needed to write down the inventory in line with GAAP. Lower cost or market was used to evaluate inventory and proper write-down procedure. Two employees, Eric K. Bardman, former senior VP of Finance, and Jennifer F. Wolf, CPA, were contemptuous with keeping the write-down of inventory to a minimum and lied about excess inventory to the independent auditor. To keep it simple and straightforward, they knew Review was not in production anymore, and there was no plans to build out more with the excess inventory. To keep inventory write-down to a minimum, Wolf lied to the independent auditor, explaining that they were using the excess inventory to build out another 79,000 units at Review, keeping the write-down to a minimum of 1.1 million. Wolf lied and knew there were no plans to use excess inventory. She wanted the auditor to believe the useless inventory was being used to produce more Review, giving the inventory more value, allowing for a smaller write-down. We can see the ethical dilemma is top management maintains their financials by knowingly not applying LCM analysis that accurately presents Logitech's inventory valuation, potentially misstating the financial statements. Wolf and Bardman are working to manipulate the operating income to inflate income and revenue for the year by not properly adjusting the excess inventory value and lying about plans to manufacture more Review. They also failed to tell the audit the company had plans to reduce the price of the finished Review each month till they were sold. If for a moment we think about what effect an inventory write-down on the income statement has, it lowers the income by expensing the cost of goods sold in the period and lowers the inventory account on the balance sheet, as we can see from this example here. By doing so, they overstated operating income by over 30 million and should have reported operating income in the amount of 112 million. Wolf and Bardman both met with the independent audit team and confirmed with them on the LCM analysis and that Logitech was fully committed to producing more Review units. Both were lies. Both Bardman and Wolf knew there were no plans to produce more and were explicitly told when inquiring with VP Global Sourcing there was no plan to produce more Review units, and that in fact it was a far-fetched idea to think so. When an independent auditor continued to ask about the excess inventory valuation analysis done and asked that it be adjusted, Logitech's regional finance accountants resisted, headed by Bardman. Wolf also mentioned they would make even more Review units beyond the 79,000 she lied about with the excess inventory. As we can see, the attempt to manipulate operating income for the year, Wolf and Bardman are going to great lengths to ensure they meet expectations. We saw earlier that the share prices fell sharply after adjusting earnings for the year. Logitech is not the only party affected by management decision making. Logitech is a publicly traded company with many shareholders who saw their investment die and surely plummeted much more at the news of the fraud being unveiled years later. The auditors also have a reputation to protect, and by management's action, their reputation is possibly tarnished to a certain degree. Even though they persisted with getting an adjustment, they were met with false information provided by high-level employees such as Wolf and Bardman. Employees at Logitech who may have held stock options certainly lost a lot of value, and in some cases might not be worth the exercise price anymore. The effects of Bardman and Wolf theoretically stretch much further than those directly involved or who have a direct relationship with Logitech, such as other CPA firms or CPAs who may now seem less capable of providing assurance to the public as an indirect effect of Logitech's fraud. As fraud continues to be unraveled, firms worldwide and the accounting profession are looked at negatively because often they are the ones who are testing controls, accounts, and the validity of information tied to those accounts and controls that are important in providing reasonable assurance and detecting risk. I will now hand you over to Miriam, who will discuss the ethical theories, models, or standards for the case and how they apply.
Hello, my name is Miriam, and I will be discussing the pertinent ethical theories, models, and standards of the case. At its core, the ethical theory applied to this case by Eric Bardman and Jennifer Wolf. And really, all of the Logitech during this period of leadership is egoism. This is the ethical theory in which people make decisions based on the promotion on their own self-interest in accordance with their own reasoning. It is driven primarily by selfishness and the thought of maximizing one's own gain. In this case, Logitech's leaders were driven by their own interest and were accepting of the consequences. Wolf and Bardaman knowledgeably deceived auditors and shareholders with the moral perspective that they were attempting to maintain a higher share evaluation by retaining the revenue expectation for those quarters. They were also attempting to save their own professional evaluations as financial leaders of the company. They were expected to perform at a higher level. Therefore, they were engaged in rational egoism, as they believed it was rational for them to deceive investors on the revenue product, manufacturing, and sales levels. In their perspective, it is rational for them to deceive investors and auditors since they were increasing the financial value of the company and rewarding existing shareholders rather than punishing them. An important ethical theory being broken throughout this case is rule utilitarianism. Rule utilitarianism dictates that certain rules should never be violated, such as SEC public information requirements, regardless of any utilitarian benefits. Shareholders depend on honest and fair evaluations from businesses and leaders on state of the company. Without confidence in the system of rules, this shatters confidence in the underlying stock of Logitech and put further pressure on the company to be scrutinized. The ethical dissonance model describes how cultures are created in a company. The individuals within the company's ethics are measured against the organizational ethics overall. This defends the culture of the company and likelihood of committing fraud or deception. In applying the ethical dissonance model or person-organization fit, it is clear that Logitech had a system of low organizational ethic and low individual ethic. This is a culture that is of a low ethical development, which makes a culture of corruption occur. It makes employees more likely to participate in corruption and fraud rather than whistleblow and prevent it. Despite many people aware of the financial misrepresentation and repeated auditors' warnings, Logitech's employees, even below Wolf and Bardaman, failed to whistleblow. The most commonly applied fraud risk model perfectly applies in this case, the fraud triangle, which consists of opportunity, rationalization, and pressure to describe why a company person commit a fraud such as this accounting fraud case. The opportunity of accounting fraud was available when the company severely lacked internal controls and any employees willing to whistleblow. The leaders of the organization were aware of the ability to control the situation and report fraudulent revenues, cost of goods sold, and inventory levels. In terms of rationalization, they argued that the information was reviewed and in accordance with accepted standards, thus not misleading to the investing public. They argued they were compliant with GAAP. They also rationalized their decision by explaining partial setbacks in sales price evaluation and thus believing this was enough to warn investors. Lastly, the pressures to perform as CFO and leaders with a failed product is immense. The leaders of the company were attempting to retain a higher stock price and hold on to their position. Next, Motoko will be diving deeper in in the case questions. Thank you.
Hi, my name is Motoko Sibui, and I like to start my part of the presentation with corporate governance at Logitech. Corporate governance refers to developing formal systems of accountability, oversight, and control to make sure that management operates the company to meet the interests of the shareholders. A strong corporate governance system minimizes the opportunity for employees to make unethical decisions. The pillars of successful corporate governance are accountability, transparency, fairness, and independence, which were all compromised in this Logitech case, and that is largely accountable for their fraud. The weaknesses in Logitech's corporate governance systems include the internal controls were ignored and overwritten by management, inadequate oversight of the internal controls by the board of directors, poor oversight of management, lack of proper procedure to monitor and control risks, lack of ethical tone at the top, and lack of transparency. These weaknesses also affected the work of the independent auditors as well. They allowed the top management, such as the CEO and the CFO, to hide the company's true operating and accounting decisions from the independent auditors. As a result, the weaknesses hindered the independent auditors to fulfill their obligation to protect the interest of the shareholders by providing the financial results that are free of material misstatement and are presented fairly. There are many red flags that indicated that earnings management took place at Logitech. Although Logitech was trying to sell all the excess component parts, and they knew that these parts would not be used in the future production, so its market value was minimal. Logitech falsely used the lower of cost or market inventory write-down to make its value decline look smaller than it actually was. In addition, although Logitech had no such plans for the future, they misinformed the independent auditors about the future review production using the excess component parts, as well as the company's plan for the future review production. Logitech also misinformed the independent auditors that the proper amount of write-down of finished goods inventory by not making adequate future price adjustments. By using this earnings management for inventory accounting, Logitech was managing to artificially inflate its financial results to meet operating income guidance. The violations of the AICPA Code of Professional Conduct by Jennifer Wolf include responsibilities, the public interest, integrity, objectivity, and due care. Wolf failed in carrying out her responsibility as the company's CFO, acting controller, and CPA because of the unexpected failure of review and the sales being below the forecasted amount. Wolf was under tremendous pressure to meet the investors' expectation and maintain the numbers on the financial statements. Her integrity, objectivity, and due care was compromised by intentionally manipulating the accounting for inventory, lying the independent auditors about the company's operation and accounting decisions, and providing materially materially misleading information to the users of the statements. Wolf ignored the suggestion from the independent auditors and the regional finance department that adjustments were needed for accounting its inventory, although there were specific GAAP rules that Logitech were required to follow. The conduct of independent auditors in this case violated the public interest and due care. Even though they were not correctly informed about the company's operating and accounting decisions by the CEO and the CFO, because they should have employed their professional skepticism and investigated further about the inventory of the finished goods and excess component parts. If they did, they would have realized that review units were not shipped from the manufacturer since November, and the production had stopped in December in 2010. By not being able to detect their improper accounting and providing the materially misstated financial statements to the public, the independent auditor failed to fulfill its duty. That is the end of my part of the presentation, and now I'm going to pass it on to Paige.
Thank you, Motoko. Knowing what we know, we may be asking ourselves what the staff accountants should have done if they were aware of this situation. First, they have an obligation to escalate the matter internally. They should go to the internal audit committee to raise their awareness to fraudulent practices that they may not even be aware that are occurring. The executives of the company, as well as the board of directors, also need to be made aware of this. They need to be given the opportunity to correct it. And in some cases, an event like this might be a mistake or a misunderstanding, and raising concern within the company allows for the issue to be corrected without affecting the company's image. While the executives are the ones who caused the issue in this case, it's unlikely that anything will be done to fix it. After taking the proper steps internally, the staff accountant would then be expected to go outside of the organization to report these wrongdoings. Concern could be raised to an external auditor if they're presently conducting an audit of the organization, or to an outside agency such as the SEC. As a whistleblower, the staff accountant would have protections under the Sarbanes-Oxley Act and the Dodd-Frank Financial Reform Act. Under Sarbanes-Oxley, protections apply to those who disclose a potential violation before it happens. They have to reasonably believe that the likelihood of the violation occurring is imminent and actually report it. The protections also apply to those who mistakenly believe that a violation of the law has occurred and choose to report it. The employee must prove that a reasonable person in the same factual circumstances with the same experience and training that they have would also believe that the employer violated the law. Under Section 806 of Sarbanes-Oxley, which links to Section 12 of the Securities and Exchange Act of 1934, organizations are prohibited from retaliating in any form, whether it be termination, harassment, demotion, etc., against employees for doing anything legal. This includes providing information concerning any conduct that the employee believes to be in violation of the SEC rules or regulations, or a provision of federal law related to fraud against shareholders. This includes when the information is provided to or the investigation is conducted by federal officials, members of Congress, or any supervisory committee. Like Sarbanes-Oxley, the Dodd-Frank Financial Reform Act also prohibits retaliation against whistleblowers. Under Dodd-Frank, a whistleblower is any individual who provides information to the SEC relating to a violation of the securities laws that has occurred, is occurring, or will occur. This information must be provided based on the whistleblower's independent knowledge or analysis and cannot already be known by the SEC. The information cannot be derived from an allegation made in a judicial hearing or a government report, hearing, audit, or investigation. Also, the whistleblowing must be done voluntarily by the whistleblower. They must provide the information prior to being asked for it by the government, a self-regulatory agency, or the PCAOB directly. Section 922 of this act states that an award is available for whistleblowers of not less than 10% and not greater than 30% in total of what has been collected of the monetary sanctions imposed in the section. Internal accountants are prohibited from receiving this kind of whistleblower award because of their pre-existing legal duty to report securities violations. This includes individuals with internal compliance or audit responsibilities to report suspicion of illegal acts and fraud to management. However, internal accountants can be eligible for this kind of reward in 3 circumstances. The first circumstance is that disclosing this information to the SEC is needed to prevent substantial injury to the financial interests of an entity or its investors. The second is that the whistleblower reasonably believes that the entity is impeding the investigation of their misconduct by ways such as destroying documents or improperly influencing witnesses or potential witnesses. The last is if the whistleblower has first reported the violation internally and 120 days have passed without any action to correct the issue occurring. We'd like to take this time to thank you for allowing us to share our presentation with you. All of our information came from the textbook, and here's our citation here, and no outside sources were used. Thank you again.